Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. Today's topic is capital allocation and manager selection. And we had a great pleasure to speak to David Salem, the co-chairman of New Providence Asset Management, a firm that provides investment office solutions for endowments, foundations, and family offices. He's also a contributor to Epsilon Theory, an online community where he writes extremely thoughtful articles about investment management and combines it with his passion for the game of baseball. And I highly recommend anyone listening to go check it out. Before assuming his current post, David served as a managing partner at Windhorse Capital, which merged with New Providence in 2018. For almost 2 decades before that, David served as a founding president and CIO for the Investment Fund for Foundations, or TIFF, a nonprofit investment cooperative that managed over $8 billion on behalf of more than 700 endowed charities by the time he left. We get into a lot of different topics during this interview, including the Yale model, which then became known as the Endowment Model, and why David thinks it may be dangerous for institutions to try to replicate that model. We also talk about David's framework for selecting money managers, what his due diligence process looks like, and what he focuses on when meeting a money manager for the very first time. And of course, much more than that. And this was a true treat for me, and I'm sure that for any of you who are involved in capital allocation, I'm sure you're going to learn a lot from this. So if you do enjoy it, please don't forget to leave a 5-star review on Apple Podcasts or wherever you get your podcasts, as always. And without further ado, please enjoy our conversation with David Salem. David, thank you very much for agreeing to speak. It's a true pleasure and honor to have you on. As we were talking about before we started recording, I became a fan of yours ever since I listened to you speak at the Patrick Shaughnessy's podcast. I thought your comments there, especially as it relates to the Yale Endowment Model, and I'm sure we're going to get into that in a minute, were very interesting. And then doing research for this podcast, I read some of the articles that you've put out. But before we get into any of that, I'd like to give you the chance to first introduce yourself and tell us how you got into investing.
Yeah, thank you very much. Well, I was very fortunate, I think, along with other people of my vintage and age, to have the opportunity to go into asset management at a time where we didn't know it at the time, but large tailwinds were gathering, so to speak. This was in the late 70s and early 80s. I did some graduate school work in Boston and thought I was going to be a lawyer. I still have a bit of a legal bent or proclivity and a passion for that kind of thinking and analytical work. I was enamored of what in business school, caught wind of what was going on in the asset management industry, and having a bit of a contrarian streak then and probably still today, thought everybody else is going into real estate and strategic consulting. Those were the sort of hot places for newly minted MBAs or even JDs, lawyers, to go. And I wound up in the asset management industry. Just to finish a very long but very happy tale, I had the opportunity pretty early on in my career to be mentored by some terrific people. It further reinforced my judgment that this was not a bad place to hang out professionally. And that was principally Jeremy Grantham, who was just starting to ramp up GMO's work in asset allocation, having been primarily an equity-oriented shop. And so during my relatively brief tenure at GMO, which I'll come back to in a minute, I had an opportunity to start to think more expansively about capital deployment in a multi-asset, a multi-strategy, and certainly a multi-geography kind of a way. On the strength of that experience and some contacts that I was fortunate to develop while at GMO, I was given the opportunity in the early 1990s, with help from a lot of people, including principally the MacArthur Foundation in Chicago, asked me to launch what became the Investment Fund for Foundations, a not-for-profit investment cooperative serving exclusively not-for-profits, mostly in the U.S., almost exclusively in the U.S., but we had some money from overseas as well. And I did that for almost 20 years. and then for various reasons that probably go on beyond the scope of this pod, decided to leave the not-for-profit sector on a full-time basis, although I still remain quite involved, and continue to manage money using the same kind of multi-strategy, multi-asset, multi-geography, and almost by definition, if you're going to try to find the very best people, multi-manager kind of a framework. And I've done that since leaving TIFF several years ago. And as you know, Leo, currently very fortunate indeed, and be honored to be the co-chairman of New York City-based New Providence Asset Management, which manages money for a small number of very wealthy families and some institutions as well. I think I'll stop there and turn it back to you.
This is one question that I grapple with, whether if you want to be a successful asset allocator, do you need to have a direct investing experience, meaning working directly at let's say a hedge fund or a private equity shop? In your case, it looks like you've always been an asset allocator at heart. Please correct me if I'm wrong. And if that's the case, do you think you miss anything, or you think you can be as good as anyone without having that direct experience?
That's a great question. I'm just chuckling because, of course, I've missed almost everything, but I've nonetheless, at least to date, had a fun and rewarding career. But I'm going to just cite a principle that I believe in very strongly, and I've clung to dearly throughout my entire career, which is not an original thought, but it's simply that every generalization is false, including that one. So, but by that, I mean, by way of answering your question very specifically, I think almost any path to asset management, and by asset management, I mean it broadly defined to include someone who works at a long-only shop focused on a specific sector or geography, or at the other extreme end of the spectrum, somebody who's running a massive pool of capital, whether a defined benefit or an endowment, and the money's all over the world with many, many managers and geographies and strategies and so forth. There's no unarguably correct path to success. I think rather success, however you define it, but certainly the way I define it, in almost any corner of the asset management industry, presupposes something pretty simple. Now, having said every generalization is false, I'm about to advance one, so I'll caveat it in that fashion. Mm-hmm. But what it really presupposes and requires, and it's why I've enjoyed my work as much as I have, is almost limitless intellectual curiosity. And that is, of course, to be distinguished from mastery of any topic or subject, or topics plural or subjects plural. Because I don't think, unless you're really hubristic, you can ever claim to be truly mastered anything where there's dynamism in the process. And obviously in the asset management business, because it's focused on capital markets, it's inherently dynamic. The capital markets are ultimately the root cause of dynamism in the global economy. I don't think anybody would argue with that. And if you have curiosity, you enjoy exercising it, and you particularly have a passion for just learning, I think almost irrespective of your background, you can do quite well. I have, as you know, I think, Leo, in some of my writings from time to time, saluted several of the people who helped me in my TIFF, Investment Fund for Foundation days, including particularly David Swenson at Yale and Jack Meyer at Harvard. They are both, I think, investment professionals. I could cite many others, men and women, who have displayed consistently throughout their adult lives, their professional lives, that the curiosity to which I'm referring. And I mentioned David in particular because, as you surely know, when he was named Chief Investment Officer at Yale in 1985, he did not have any direct investment experience. He had other experiences that I think were rightly perceived by Yale trustees as germane to the task of deploying Yale's investable wealth in a sensible, and now in hindsight, an extremely successful manner. But if someone had reviewed his CV or resume just before he started working at Yale, it would not be obvious to many fiduciaries that this would be somebody who would really prove to be the success that he has. I could cite many, many other examples, but that's why I said, finishing this answer to your good question, almost every generalization is false.
Absolutely. And you touched on a topic that I wanted to get into, which is David Swensen and the Yale model. And you talk about this in your writing quite a bit. Can you maybe summarize for the listeners who are not familiar with it, what the Yale model and the endowment model are, and why you think it may be dangerous for other asset allocators to try to replicate it?
I'll start with the last point first. I have written about that extensively. None of the thoughts I'm about to advance are original, at least they're not labeled as such by me, but I think they're obvious and they're important. They're important for people who are tempted, I think, in many cases unwisely, to try to mimic the Yale model. I'll define it in just a minute. And by mimic, I mean identify the strategies and tactics that David has used at Yale, that other endowments may have used in other institutional funds, and said, well, if I just do that, I will be successful. As I like to say, and as I've repeated in writing on many occasions, mimicry of that form is almost destined to fail. What could succeed if you execute it adeptly enough is mimicking the mindset, the underlying philosophy, which is getting harder and harder to do. In some of my writings, I've labeled it, using a baseball term, hitting them where they ain't, which is to say, try to find unpopular, unloved, uncrowded niches of the global capital markets in which you think you can gain and hold an edge. Now, hold that thought as I come back to the simplest possible definition of, let's call it the endowment model as it's come to be viewed, certainly here in the States and really elsewhere as well. It is for long-term capital, therefore it ought to have a pronounced equity bias. If there's a tolerance by the owner, in this case, perhaps Yale or a wealthy family, for a certain degree of illiquidity, one of the fundamental premises on which the endowment model is based is that if you're willing to incur illiquidity and you're adept and skillful at picking your opportunities in illiquid markets, you have the opportunity, at least potentially, to earn a return premium for bearing that particular form of risk. More to the point, and this was a really important premise on which David Swensen executed what's come to be regarded as the Yale model, is favor illiquidity because they're corners of the global capitalist system in which inefficiencies are particularly pronounced. Putting the same point differently, there's a large dispersion of results, particularly by full-time investment professionals, otherwise known as money managers. And money managers, as I'm using it here, is a broad term to encompass not only managers that are managing publicly traded stocks and bonds, but it would be venture capitalists, real estate managers, whatever asset class or subclass you're talking about. You're talking about compensated investment professionals. The dispersion of results tends to be much wider in certain illiquid or private markets than it tends to be in general, with certain obvious exceptions, than it tends to be in public markets. Other premises on which the so-called endowment model are based, if you're incurring illiquidity, almost by definition, if you're paying very careful attention to your cash flow needs and requirements, you're going to want to have a certain degree of diversification, not to excess. You want to concentrate because you want the smallest, what I call a circle of competence, not an original expression, that you possibly can, so that you can achieve the important goal of knowing what you own and owning what you know. And if you have an excessively diversified portfolio, it gets harder and harder if it's measured by the number of managers or the number of underlying holdings or geographies or strategies or tactics, currencies, however you want to measure diversification. Excessive diversification can inhibit the very important goal of knowing what you own and owning what you know. So diversification to a prudent but not excessive extent is the other key premise on which the endowment model rests. Now, taking all that into account and not forgetting the question that I was trying to respond to, the reason it's very dangerous for many people to try to mimic that is either because they don't have the mindset that's required to succeed applying that model, or they don't have the resources. The resources can take two forms. They're both important. A capital base that's sufficient to be adept in all of those forms of investing, and then the human resources to do it in a thoughtful, careful way where you're making decisions not in a hasty manner, but in a timely manner. And to David Swenson's great credit, I could cite many other allocators, some of whom you're familiar with, some of whom I've had the privilege of getting to know well over the years or working with in various guises. And in many instances, it was with my TIFF hat on. I would point to Seth Alexander running the MIT Endowment, who trained under David for 10 years at Yale. Mm-hmm. Certainly Scott Malpass and his team at Notre Dame in Indiana, and others that come immediately to my mind, but I'll stop here. Mm-hmm. They are, I think, generally speaking, very happy and conspicuously successful exceptions to the rule that you should not try this at home. By that, I mean, don't try to apply the endowment model or the Yale model in particular, unless you think you have a rather robust supply of the prerequisites for success, as I just identified them.
You mentioned diversification, so I wanted to ask you, how do you think about it? So how do you, in a practical way, decide how many managers or how many stocks within the managers that you've selected is too much or too little? How do you think about that in a practical way?
Well, it has to be done on a portfolio-specific basis, which is to say, for example, in my current role at New Providence, I'm part of an investment team, a firm that has several $1 billion under management, as I said earlier. Some are wealthy families or some are institutions. So the degree of diversification for any one of those portfolios, and we do have some commingled fund as well, is a product of the mandate. And mandate in my world, in my brain, means something very specific. It means the types and degrees of risk that the ultimate owner of the portfolio, the wealth, is willing and able to incur. And like a doctor working under the Hippocratic Oath, where the first imperative is do no harm, so too in our business of asset management, the first principle is always do no harm. I mention that because, among other metrics, you asked about diversification or concentration. It would be professionally irresponsible, if not negligent, to subject a client's wealth, whether it's an institution, it could be an endowed charity or a pension plan, or a wealthy family or individual, to subject them to types and degrees of risk that under worst case conditions, they are unable to tolerate. And you always need to think about worst case conditions. As I like to say, crisis reveals character, whether individually or institutionally. So when you sit down and construct a portfolio initially on behalf of a given owner, again, it could be an endowed charity, a wealthy family, it could be a defined benefit pension plan. It comes in many different guises. You need to think really rigorously up front. How do I design this entire investment program so that, presuming that it's long-term investing and not trading, and my entire career has been focused on long-term investing as opposed to trading or speculating, I need to design a program that maximizes the probability that the ultimate owner of the capital will stay the course when the risks that the client in question is incurring are most conspicuous. So, for example, if it's an endowed charity that has essentially, at least in theory, a perpetual time horizon, you know, and I know, and many people listening to this recording will know that long-term and equity bias, generally speaking, is a wise course for truly permanent capital. But the price you pay for that are, we know historically and intuitively, are these episodes where you have to incur a lot of pain. Drawdown is another way of describing the phenomenon. And if you set a client or a portfolio down a path that is likely to lead to a bailing out when that particular risk is most manifest, you've done neither yourself nor the client a favor, but rather a great disservice. So getting back to the central question that we had, the main thread was diversification. how do you measure it? It's got to be done on a mandate-specific basis. So it follows that if a client comes to me or somebody just seeking my advice and says, I've been fortunate to amass quite a bit of personal capital. I have 90% of my portfolio over here in something that's very safe and not very volatile, and I'd like your help in deploying the residual 10% in a manner that could lead to maybe a significant increase in my philanthropy over time if we do really well. Or it could be something as very straightforward, and there's nothing wrong with it, as a significant increase in my standard of living, my spending habits, because I've done really well with this 10% set aside. Can you help me deploy it in a manner that is pursuing a return distribution that might look on paper very different from what we could project for the 90% of my wealth that's kind of my core portfolio? It would therefore follow that 10% sort of satellite portfolio might be theoretically a lot more concentrated either by strategy or geography or manager than would be case with the main portfolio. I guess what I've said in the last several minutes is, as I said at the outset in response to a different question, just about every generalization is false. The one thing I will cite, and then turn it back to you, Leo, with apologies for a long-winded answer, is I really believe emphatically in this idea of the circle of competence. Again, that is not my original term. You hear it from Buffett, you'll hear it from Munger, you'll hear it from many other people in our industry. But I believe in it to the core, which is what you want to do ideally, if you're trying to develop over time more and more competence defined as an understanding of what's really causing your holdings to move in a certain way, then you actually want the smallest circle of competence for yourself as an investment professional and on behalf of anybody you're serving as a hired gun or an outside manager. The smallest circle of competence that gets the job done. And what do I mean by getting the job done? I mean that gets them the highest possible return while honoring sensible risk parameters. Or putting it differently and using words I already used earlier in this answer, that it subjects their capital to the types and particularly the degrees of risk that they will deem tolerable, even when those risks are really making themselves palpable. It's showing up in the returns as a negative red number, and you want them to be able to stay the course. Back to you.
Sure, thank you. Please don't apologize for a long answer. That was great. And one question that I would ask as a follow-up is, if you were advising an endowment or a wealthy family, of course, by knowing them and filling out questionnaires or whatever it is that you try to gauge the risk tolerance of the investor, I think the surveys have shown that people tend to underestimate their tolerance for risk. So if I model my portfolio based on those answers, it might happen that if there is a large dislocation in the market, regardless of how much diversification you've tried to achieve in your portfolio, the total drawdown that you expected is actually much smaller than what actually happened. And then you have people sitting in a room making a decision on whether to sell everything or to buy more, and animal spirits come in play. So I wonder if you've thought about, or if you have an answer to, how do you even account for those more psychological fallacies that we as human beings actually making decisions for these families and endowments have? That was a long-winded question.
Great. No, it's a really good and it's a fundamentally important question. So let me give you my take on it. For better or worse, I have thought about that very question a lot over the years. And it's a fundamental boundary condition that we cannot escape, whether we're deploying our own capital or somebody else's for a fee. So the way I like to deal with the problem, which is ineradicable in the sense that you can't get you can't get rid of the problem, you can only manage it, is to kind of shift the focus. And I've tried to do that over the years, and I've had the great good fortune and honor of having an opportunity to design, large-scale investment programs from scratch. So I was able to do that with help from others, but as a member of the investment committee of the Atlantic Foundation, which became the Atlantic Philanthropies, a very, very sizable fund, very unique path to philanthropy, now wound up because they gave away all the money, but it was a very successful program. I was given the great honor of sort of a whiteboard exercise from my college alma mater, Middlebury College in Vermont, and I was asked to join the board of trustees at a time where they were willing to take everything they'd done historically with the endowment, set it aside and say, if we were designing everything from scratch, what would it look like? And I very much enjoyed that role. And then with my TIFF hat on as well. What I'm driving at by citing those examples is in each and every case, the way I try to manage the ineradicable problem that you flagged in your question is by shifting the conversation not to return objectives first and foremost, but to something I've already alluded to in this conversation, which is risk parameters. So what I said to them is, let us have a patient, thoughtful, careful, collegial discussion about the types and degrees of risk that we're willing to incur, whether it was Atlantic or Middlebury or a major TIFF fund, and indeed in my current guise working here at New Providence. Let's think about the types and degrees of risk to which we're willing to subject the capital. Think about those rigorously, codify them to the extent that we can using simple, clear, plain language. It's almost always been English. And once we've done that, and ideally that's like a third of a page, then we will adopt a return objective. Then we will take that return objective and understand the extent to which it dictates changes in other arrangements. Let me be more specific. In the case of an endowed charity like Middlebury College, think about the types and degrees of risk to which we're willing to subject the endowment. Do the very best job you can, which means probabilistically, it's not a single point estimate, but get a very general sense of really long-term, what is likely to be the real or inflation-adjusted return, net of every penny of expense, that we can expect to earn if we continue to do a reasonably good job at a minimum in executing the investment philosophy and policy. What is the real or inflation-adjusted return we can reasonably expect to earn over a sensibly long time horizon, because this is a permanent endowment? Whatever that number is, we will then take that and make sure that everything else that's going on at the college, and you can see how you could easily apply the same approach in the case of an individual or a family. It doesn't need to be a wealthy individual either. It could be a person of very modest means who's trying to think about retirement many years down the road. Make sure that all of our other arrangements are consistent with a sensible assumption about the return that we're able to generate. In the case of a college, it might be, let's not assume an excessive amount of dollars being transferred each and every year from the endowment into the operating budget. In the case of a family, let's not assume unwisely and too overly optimistically that we can withdraw too much money from our investment portfolio in any given time period and move it over and spend it. So you want logical consistency, but the key is to go through that process in a logical order. And by my way of thinking, based on both intuition and experience, you start with risk and not return. If I can just say as an aside, it's not really an aside. I think it's on the main theme here. If you just mentally survey what's going on in the world today, the massive reaching for, it's not just reaching for current income, otherwise known as yield, but it's reaching for total return that's driving so much institutional capital towards illiquid forms of investing in general and private equity in particular. That's not catalyzed merely by the conspicuous success of the so-called endowment model, what Swenson's done at Yale with both venture and private equity, what Seth's done at MIT, Scott Malpass at Notre Dame. I could cite non-US investors that have had conspicuous success as well. It's not merely that they're trying to mimic with an eye on the rearview mirror what they deem to be successful. It's unarguably successful, the programs that I've alluded to. But it's also that they're not willing to say, oh, my return objective is excessively ambitious. And that's actually the fundamental problem that I think you have in the market environment in which you and I are speaking. And to go back to the beginning of this recording, it is the polar opposite of the environment that prevailed when I entered the asset management industry in the early 1980s. And I think just about anybody who's got an interest enough to listen to this podcast knows whereof I speak. Very, very depressed valuations, particularly on financial as distinct from real assets, and no enthusiasm whatsoever, except among a very few, most conspicuously, of course, Warren Buffett in his famed 1979 Fortune article, which had a major effect on me. I was in graduate school at the time, and I thought, boy, this is a lot more sensible than what I'm hearing and reading about both institutional investors and major corporations moving money en masse into so-called real assets that they perceive to be effective hedges against the continuance of the kind of rampant inflation that you saw in the 1970s. Those movements, big companies, GE very conspicuously, moving into energy, moving into commodities at what in hindsight to prove to be an inopportune time. Those were very reliable contrary indicators. Similarly, bringing it right back to the present, I think you're seeing a massive movement of capital animated, as I said, I'm now repeating myself, not only by the conspicuous success of folks like David Swensen and his acolytes, but as well by an unwillingness to go back to first principles and to say, is it really logical, sensible, and achievable for this particular pot of money? It might be a big state-defined benefit pension plan like CalPERS, CalSTRS, the Illinois pension funds, to continue to pursue return objectives that by any reasonable measure or assumptions about the future are very, very unlikely to be achieved. The wiser course by far would be for them to dial down their return expectations so that they have a much higher probability of achieving them, however modest they turn out to be.
This is great, and you touched on private equity, which is known for being one of many why David Swensen was so successful as being one of the early movers in investing in private assets and private equity in particular. And looking at what you see today in the market, and based on your comments about where we are today versus where we were in the 1980s. And I think you talk about this in one of your articles as well. And you mentioned Dan Rasmussen, which we had in our podcast a few months ago, and he's avidly criticizes private equity as it is today. So what's your view about private investments in general, and also private equity today? And where do you see it as part of an institutional portfolio?
Yeah, so a multi-part answer to that question. I'll try to be very brief. Number one, hat tip to Dan. I know Dan very, very well. I've spent a lot of time with him, have read every word he's ever written, and I agree fully with what he's articulated in public. Point number two, I myself have done a lot of thinking and writing about this very topic. As I think you know, I've done quite a bit of work, and I've really enjoyed it with my good friends Ben Hunt and Rusty Gwynn. They're operating under the Epsilon Theory banner, and I've had my own series within that complex called Notes from the Diamond that compare or draw parallels between baseball and investing. And in my second note in that series, and in the two most recent notes, I go into this in great detail. And so I'll encourage folks who are listening to the podcast, if they haven't already seen that, that's my full sort of explication and discussion of the phenomenon that we've alluded to over the last several minutes, in an effort to supplement but not repeat what I've already said in writing in those particular essays, Notes from the Diamond for Epsilon Theory. But tying it back to something you said, Leo, a minute or two ago, what David Swensen did, even though he called his book Pioneering Portfolio Management, and he pioneered that model that we've been talking about at length here on this pod, and he wrote about it and published a book about it, and it's been widely mimicked, as we've already discussed. None of the techniques that he applied and has continued to apply at Yale were newly hatched by Yale. they've been pursued by wealthy families and individuals for centuries. What he did is he helped the institutional investment world understand the merits of essentially relaxing either the behavioral or the legal constraints, shaping, conditioning, and therefore limiting what you could do with institutional capital. To put the same point, which I think is actually a very important point, not again an original thought, somewhat differently. When I first entered this business, there were literally legal prohibitions in most US states and in other places around the world on certain forms of investing. You couldn't, in some states, including, I'm sitting in New York today, in New York, you could not buy sub-investment grade bonds with endowed charitable wealth. Now you can. So there's been a healthy, material, more or less comprehensive reform of the legal framework governing the deployment of institutional capital, and to the extent that trustees and trustee banks are deploying individual taxable capital in those arenas as well, that have changed the entire map from what I think could be maybe somewhat loosely or flippantly labeled an arena in which you had to confine your strategies and tactics and exposures to a narrow subset of the total available universe, to a universe in which anything goes. Mm-hmm. Now, bear with me here, because if the legal and behavioral standard changes from almost nothing can go into the portfolio, it's got to be high quality investment grade, fill in the blanks in the 1930s, 40s, 50s, 60s, to an environment where legally and behaviorally anything goes, there is a temptation by a lot of investors, both institutional and individual, to say, well, if anything goes, then everything goes, which is to say, I should have a little slice of everything. Mm-hmm. The most conspicuous example of this in my entire career is right now with cryptocurrencies, mm-hmm. right? Where you hear people, and many of them are in a promotional mode, oh, this is a new asset class. You should be early because you'll be rewarded the way that Swenson was rewarded for being early in venture capital. As I said 3 minutes ago, he wasn't early in venture capital, broadly defined. He was just early as an institutional investor in venture capital. Wealthy families and individuals going back to Renaissance Italy have been very active in venture capital for centuries. But coming back to the present day and to crypto, to argue that because you are legally free, which is, I think, almost unarguably true in most jurisdictions, to put some of your money into crypto, it does not therefore follow that you should or you must do it. And in fact, I have very serious concerns about using crypto as part of any institutional or even an individual investment program. I don't think it's a fundamentally sound way. I think there are vastly better alternative ways to deploy your capital than to put it into cryptocurrency. We can come back to that if you like, but I'll turn it back to you.
Sure. Well, thank you. Very interesting. I'd like to turn a little bit into your process, more specifically your manager selection process. And so I wanted to ask you, what does your investment process look like in practice? So if you can walk us through a selection of one manager from start to finish, how does that look like?
Yeah. So let me just emphasize in trying to answer your question that I'm going to speak for myself and not the organization of which I'm currently a part. That's not because I have any substantial or material disagreements or differences as to how this should be approached. But I don't want anyone listening to the pod to think that what I'm about to describe is exactly what goes on at my current employer. Mm-hmm. Rather, what I'm going to describe is the general framework and process that I have found most congenial to the way I like to move through the world professionally. It just happens to work for me. And if it happens to work for other people that may be listening in part or in whole, that's fine. What I'm going to describe is what I call a 4-part framework. And I've used it, and I've had a lot of, I'll say, fun, but gratification using it in vetting money managers, I've also used it to vet potential employees. I've used it to think about my own career opportunities. And it's a very simple, straightforward, and unoriginal framework. But it starts with disqualifying attributes. So I said there are 4 parts. And then I look at undesirable or unfavorable attributes. That's part 2. Part 3, moving from the negative to the positive, are desirable or favorable attributes. And part 4 are just important or essential attributes. So in the case of a money manager, and the reason you apply the negative screens first is because it's easier and more time efficient to apply them. As you go from the disqualifying to the undesirable to the desirable to the essential, it gets more and more time intensive. So in the case of an active money manager, an obvious essential attribute would be a well-defined investment philosophy that gives that manager that you're vetting a discernible and clearly communicated or articulable edge in generating the excess returns that you'd be seeking. It takes hours, days, months, even years to confirm the presence of that essential attribute. At the opposite end of the spectrum, it doesn't take very much time, particularly in 2019, to go on the web and determine that a given manager that's approached you seeking funding has a disqualifying attribute. It might be something as simple as a relevant criminal conviction. I don't regard a speeding ticket as necessarily a disqualifying attribute. But if a manager in the past has cooked the books, you might say, well, I'll give them the benefit of the doubt. Maybe they won't. They've learned from that mistake and they won't do it again. That would not be my approach. My approach would be, life is short. It's a big universe of potential choices. I'm just not willing to roll the dice and assume that somebody who's committed that kind of an ethical violation or legal violation before is going to be free of it moving forward. So I'm going to disqualify them. It's pretty easy to get to some of those disqualifying attributes. Another disqualifying attribute that's pretty easy to confirm is, for example, excessive asset size. So you look at a strategy, it seems to be compelling. The track record is terrific, but you notice that the manager has gone from having 500 million when they generated the great returns to having 5 billion or 50 billion. That can be deemed, I think, somewhere between an unfavorable and a disqualifying attribute. It's obviously the case, to finish my answer to your question, that any of these attributes can sort of be applied in a mirror-like fashion, which is to say, if excessive asset size, which is really, in some ways, the problem of asset management, right? If excessive asset size is a disqualifying attribute, then a reasonable asset base in relation to the investment philosophy being applied to it is a favorable attribute and arguably even an essential one. So you can look at it through either end of the prism. The key is to be rigorous in applying a framework of this sort and to apply the screens in the most time-efficient manner possible. For most allocators, time is the scarcest resource. It's not knowledge and skill and information, because if you put enough time and you're reasonably intelligent and diligent, you can gather, accumulate the relevant information or skills. Really, time is our scarcest constraint as either investment professionals or human beings that are mortal. And so we want to use our time in the most efficient manner possible.
As you go through your due diligence of a manager, for example, and I'm assuming you have some sort of process of approval that goes through an investment committee, for example, you have some sort of documentation where you talk about different aspects of the investment, for example, the strategy, track record, the organization, alignment of interest, the team, and all that. Is there any specific area that you tend to focus on, or do you put equal weight on each of these subcategories?
Well, again, I've articulated a 4-part framework, and it gets applied on a case-by-case basis. But if you asked me, and some of these, the framework and the criteria under each of the 4 parts, they're in the public domain. They're in published writings that anybody could easily Google and get. So I'll just highlight a few by way of attempting to answer your question. The most important by far in my view, if it's an active management strategy, I'm not talking about passive or indexed or even a highly rules-based or algorithmic-driven quantitative approach, particularly where it's fundamental active management, whether in the private or the public sphere, especially in the private sphere, but even in the public sphere. If you said to me, what's the single most important thing you look for? It's, of course, integrity, ethical integrity, and intellectual integrity. And beyond that, it's something I've written about extensively, particularly in my most recent notes for Epsilon Theory. It's a passion for excellence. That doesn't mean it's a uniform achievement of excellence. Anybody who's going to attempt anything difficult in their life, whether professionally or personally, is going to have failure. But what you want to look for is somebody who's always seeking excellence in everything that they do. And again, that's somewhere between a favorable and an essential attribute in either an individual or a team of individuals. And it's not something whose presence you can confirm in a 45-minute meeting. It's something that requires many hours of conversation and interaction to develop that degree of confidence and conviction that this is an individual or a team of individuals that is going to come to work every day. And if things aren't working, ask themselves the question, why aren't they working? Do we need to do something differently, either major or minor? And particularly, I would say, a variant of what I just alluded to, I like to refer to it as fixing that which is not broken, which is to say, investment professionals who understand that everything is going swimmingly well. If that's the case, the return distribution looking forward is likely to have been reshaped from what it looked like when the exercise first commenced. So in the context of my own career, as I already said earlier in this recording, return distributions looking ahead for a lot of asset classes and subclasses, looking ahead from 2019, are radically different from what they were when I started my career. Mm-hmm. As a consequence, even if everything I were doing with capital, my own or my clients, were working very, very well, and precisely for that reason, if it ain't broke, you better think about fixing it in money management. If it ain't broke, you better think about fixing it in capitalism. Obviously, Andy Grove at Intel, the late Andy Grove, had a great way of, referring to this, which was paranoia, right? It sounds like a pathology, but paranoia can be extremely healthy, right? If it ain't broke, you better at least think about fixing it. So strategies and tactics and asset classes and subclasses that have worked really, really well, particularly recently, deserve special scrutiny. Again, back to the main thread, you ask, are there any particular attributes that you focus on in vetting a manager? And I said, well, to give you a few, focus on that endless search for excellence and a willingness to constantly re-examine fundamental premises to determine whether they are no longer sound, which is hard to do behaviorally. It's very hard to do, by the way, if you're at the top of a money management organization where large profit margins are being made and everybody's very happy with their current income. It's very, very difficult in the money management context to do what Andy Grove was forced to do and did very successfully while running Intel, right? Where it was much more obvious at a place like Intel, a semi-manufacturer, that if we don't continually innovate and introduce a new semiconductor that's faster and maybe cheaper in computing power terms than the last one, the one that we're now making money on, somebody else is going to come along and eat our lunch. Obviously, the same thing can happen in the asset management industry. It's just not as visible and palpable, but it should be.
I wanted to ask you how a first meeting with you looks like in practice. So you have 45 minutes to decide, do I give this money manager another call, or do I spend more time or my team's time and resources on trying to answer some of those questions that you've alluded to over the last few minutes? So how do you prepare for it? That's number one. That's the first part of the question. And second, how does the actual meeting look like?
So preparation. Give me everything that you've ever committed to writing. If it's a lot, I'll read every word of it. If it's a little, I'll obviously read every word of it. And I will go into the first meeting having read everything that's available. carefully. Sometimes, of course, the reading of that information causes you to say, you know what, Leo, no meeting. If this is all you've generated, I'm not interested and I'm not going to give you my scarce time, so no meeting. But assuming you clear that bar and there's a first meeting, try to do much more listening than talking, vastly more listening than I'm doing on this recording, obviously. And what I would focus on an initial meeting, and I would prefer an initial meeting after I've read carefully, presumably quite a bit of information and material, is to focus the initial conversation one-on-one on issues that have almost nothing to do with the investment approach, the portfolio, or even the investment universe, but rather to focus on the human being who's sitting across the table. So maybe a breakfast, a lunch, or a dinner, say, let's meet one-on-one. Tell me about yourself. Tell me about your grandparents, your parents. Fine if you want to talk about school, you want to talk about mentors. Well, you know, the poet Mary Oliver, one of my favorites, said, you know, in one of her wonderful poems, what will you do with your one precious life? So tell me, Leo, you just have one life to live and you don't know how long it's going to last. Why are you doing this? And if it's the head of a money management firm as opposed to somebody who's part of a much larger organization, a team, and I generally prefer much smaller boutique operations in any case, tell me why you're willing to spend time doing all the things you need to do as the head of a money management organization in addition to investing. Because I like to look at money management, however it's being practiced, as essentially a three-legged stool. This is true if it's a long-short equity fund or a distressed securities fund or private equity or venture capital. It's essentially a three-legged stool. The most important and visible leg is the investment, right? Putting money to work. Mm-hmm. Buy and sell, sizing, security, timing, portfolio construction. The second leg of the stool is what I call outreach, which is if you're seeking to manage other people's money, whether institutional or taxable individual, you got to interact with existing clients, you got to interact with potential clients if you're trying to build the business. Let's call that outreach. That's the second leg of the stool. And the third leg of the stool is other. No pejorative. It's very, very important stuff. It's HR and IT and fund administration and audit and accounting, compliance, really mission critical stuff. That's the third leg of the stool. If you're at the very top of a money management organization, and for better or worse, I've been in such a seat for much of my career, you have to spend time on all three legs of the stool. You can, through effective delegation, dial down the percentage that you spend on any one leg of the stool. But if you really love investing, you're going to be doing quite a bit of that first leg of the stool, and you're necessarily, if it's the top of the organization, going to be involved in the other two legs as well. Getting back to my initial meeting, the one-on-one conversation, tell me, Leo, why you're willing to spend time on the outreach and the other when you could, if you were working for a larger organization, spend much more of your time as a fraction of your working hours just on investing. Maybe you won't make as much money, but tell me, what is it about your internal makeup that causes you to want to be starting a money management organization, running an existing organization, doing what you do for a living? Tell me about yourself and tell me why you want to spend your time in that manner. And oftentimes, to my delight, I can put that question to somebody at the start of an initial one-on-one meeting over a lunch or dinner, and I can enjoy the meal while they talk, and I don't have to do any further talking. and I love those conversations. I really do, notwithstanding the appearance I'm creating in creating this recording with you. I vastly prefer listening to talking.
The purpose of the podcast is not for listeners to have to listen to me speaking, so this is perfectly fine. And I think they'd much rather listen to you than to listen to me. But I guess we could get into a lot of different follow-ups from this question. But in the interest of time, I think it would be interesting to hear after. So you've gone through your process, you've had your first meeting, everything is wonderful. You're still convinced that the money manager is a good fit for your organization, and then you go to a meeting with a group of people, an investment committee meeting. How does that room look like for you, and how do you make sure that the decision is made by the group is the best decision possible at the end?
Well, let me challenge the premise a little bit. I've done quite a bit of thinking about this and quite a bit of writing about it over the years. So committee decision-making is about the worst possible form of governance for investment decision-making. It works very well in other contexts, whether it's the wisdom of crowd being applied to product design or product management or fundraising in an endowed charitable context. But committee decision-making in an investment context can be somewhere between dangerous and lethal. So, in fact, the single most fun I've had as a public speaker was giving a talk in my graduate school alma mater several years ago, which I labeled "Imperfect Practice Makes Imperfect: Investment Committees at Work." And that's publicly available without not too much searching. People can find it on the web, or they can ping me through you and I can send them a PDF. Mm-hmm. But it's basically a catalog, which I had a lot of fun compiling over many months of all the mistakes committees make. So I don't really much like being part of an investment committee that's actually making decisions as a committee. I have no problem whatsoever with having a committee or a board of trustees or an informal board of a wealthy family oversee the process by which investment decisions get made. But I believe emphatically in the skin in the game concept. Skin in the game in my world means not only tangible financial reward, but intangible reward and sufferance or penalty, meaning that you're committed to the best possible result, knowing you can never achieve perfection in anything in life, particularly investing. But as an individual or a very small team, not operating as a committee, but everybody that's really playing a pivotal or critical role in an investment decision, whether it's picking a security or a manager or a new framework for asset allocation, has skin in the game defined in the two-part way that I just cataloged. Psychological incentives, intangible rewards being almost of equal importance with financial ones, so that you really have ownership of the results, and you therefore ex ante or before the fact, as the decision is being made, mentally, you're calling yourself to account. You're thinking about the full range of potential outcomes and thinking about what could go wrong in addition to what could go right. So that you never have what you see too often in our business, which is this sort of heads I win, tails I don't lose, right? Where a decision is made and everybody likes to claim credit for the successful ones, and they like to avert blame for anything that doesn't work out very well. Successful and sound governance arrangements avoid that like the plague. So try to get the smallest possible group that is conducive to an informed and fully critically considered decision. If you put a gun to my head and said, David, well, okay, I hear all that, but can you be specific? What is the optimal size for a group that's engaged in investment decision-making? I would say, based on my experience and intuition, in general, the optimal size is 3. Mm-hmm. It's not 1, because you may not have enough critical consideration of the decision if there's a sole decision maker who's not benefiting from critical scrutiny and dialogue and conversation. Mm-hmm. When you get north of 3, you start to quickly and in a non-linear but rather geometric way degrade into lowest common denominator decision making. So that's a long-winded response to the premise on which your question was based. So let me turn it back to you and let you either rephrase or take us in a different direction.
No, this is great. I think just your opinion on the effectiveness of investment committees is already a great answer. One other question that I've been dying to ask you is, once you're invested in a manager, let's say it's an open-ended investment in an absolute return manager or in a public long-only equity manager, at what point do you decide that things are not working out?
I have a very straightforward answer. I hope I can state it very concisely, and I hope you find it appealing, if not also your listeners, which is it harkens back to the framework that I've alluded to multiple times during the recording. a 4-part framework: disqualifying, unfavorable, favorable, and then important or essential is the 4th part of the framework. And so why do I mention that in response to your good question? Because what you want to be doing as an allocator or a manager of managers in this context is continually, on an iterative basis, apply that framework. So you use it up front. Maybe you modify the framework over time. I certainly have, but not materially. It's basically the framework I've been using my entire career when vetting investment professionals, and separately when vetting potential employees as well. But on the manager front, apply the framework initially, and then just apply it as time evolves. Not every single day. I don't come to work every day and think, okay, I need to do a fresh underwriting of our Japan-focused manager. I need to spend 3 hours today doing exactly what I did for the first 3 hours yesterday. Not much has changed. Not much will have changed that would justify that kind of an exercise. But on an ongoing, with sufficient but not excessive frequency, at least mentally, close your eyes, turn off the phone, turn off your PDA, and think about, okay, I understand, I remember the process we went through, and we applied a framework when deciding to allocate capital to this manager. If we were doing it afresh today, would they still clear the bar? And you might say, well, David, that's a rather vague and amorphous question. I asked you what triggers would cause a firing. And I would say, in response to that conjured follow-up question, since you understood when applying the framework initially that you would never, ever find a perfect choice. You will never find, if you apply a framework of the sort I have described in this conversation and used extensively over the years, if you apply such a framework, there will never be a perfect or ideal choice. You're always making trade-offs. If that's the case, as time evolves and you're making trade-offs, then as you're applying this framework, at least mentally, to managers that you already employ, if any of them happen to develop or manifest what you deem to be a disqualifying attribute, one that would have caused you to not hire them to begin with, then it therefore follows that they need to be terminated. If it is not a disqualifying attribute, but rather an unfavorable attribute, it's a little bit more difficult. Meaning you've got to roll up your sleeves, maybe get together with the managers and just say, I'm seeing some signs that indicate to me that the particular set of trade-offs we're making in continuing you to have you manage some of our money, maybe the balance is starting to tip too much to the negative. Let's discuss. This is what we're seeing. Either give me confidence that I'm misperceiving the way your firm is or strategy or you individually are evolving. And if it's not a misperception, it might ultimately lead to either a partial or a full redemption. Let me stop there and let you either pose a clarifying question or we can move on.
This is great. I realize that we've spent a lot more time than I asked you to, so thank you for taking the time. But I think one last question that I wanted to ask is, and I listened to an interview with a gentleman called Chris Brightman, who is today the Chief Investment Officer at Research Affiliates. And when he was asked who were some of his mentors, he mentioned you, which was quite surprising because I wasn't listening to his interview in preparation for this. So I quickly wrote it down and decided to ask you this question as a final question. What is it like that you think that makes Chris believe you are one of his mentors? And what is it like to work for you?
Well, I'm honored to hear that. I'm a Boston native, as I think you know. And while I've worked hard to eliminate my Boston accent over the years, it comes to the fore from time to time. And it will right now when I say Chris is wicked smart. And that's not by way of saying, well, obviously he's smart in his assumption or his comment that I'm a valuable mentor. I'm honored by that he happened to say that. I have a great deal of respect for his intellect and that of the other people with whom he's working at Research Affiliates out in California. They display a lot of the attributes that I've spoken of on this recording. They have a passion for excellence, I think unquestionable intellectual integrity, and sort of an endless search for the truth, if you will. I would like to think that, to try to answer your question more specifically, this closing question, that people that have worked with me or for me would say that I am open-minded, fair-minded, and then in my own personal imperfect search for excellence and the truth, I'm always willing to admit that I'm wrong, either conditionally or absolutely, and I always welcome ways in which I can do better. And in turn, I recognize that there's a responsibility and maybe even more importantly, a very important source of gratification as you move through life and through the world. Almost nothing is as rewarding to me as helping people get better in their own eyes. So the most rewarding experiences I've had are when people I have worked with or who have worked for me have turned to me and said, thank you. You've helped me become a better person, a better investment professional. And I'd like to think that at least a few of the people that I've worked with and who have worked for me would be willing to say that. And again, I'm honored that Chris would cite me among presumably other people that he regards as valuable mentors. I've certainly had some very valuable mentors over the years, some of whom I've named specifically in this pod. I don't think I gave enough of a shout out to Jeremy Grantham, so I will just point as well to him. I did have the great privilege and honor of working with Jeremy and at a very formative stage in my career, and I'm eternally grateful for that opportunity. And for this opportunity to chat with you, Leo, too. I'm really honored by it, and I hope you found it helpful.
David, absolutely. In your final answer, I think the only thing I can say now is thank you, because you absolutely have made me learn quite a bit. I wish I would have more time with you, and I'm sure that listeners who are interested in this world of asset allocation and investment management will certainly learn a lot from you. I would certainly encourage everyone who's listening to read your articles. It's clear just by reading them that you're an avid reader yourself, just by the words that you use and how clear your thoughts are. So I don't know if anyone else has ever told you this. I'm sure they have. You should definitely write a book about these thoughts, because they are pure gold, and I'm grateful that you took the time to share it with us. So
I appreciate your kind words. I've enjoyed it. Thank you, Leo.
Thank you.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.